Okay, continuation of chapter 24. Here, there's just showing you a department income statement, and and they're going to allocate the direct expenses and direct revenues without allocation, i.e., it's just fully layered, and they're not splitting it off to other departments, which is acceptable, of course. Indirect expenses are allocated and using appropriate allocation basis. This is argumentable. Is it appropriate? You need to evaluate that. Again, it's not uncommon that there's a little bit of gamemanship in this, as well as politics. And then you get total expenses. It's your, all your direct as well as your allocated indirect, and you simply add those two up. Allocation spreadsheet. Yes, there's a lot of spreadsheets, and again, there's just different methods, but they're gonna give you the direct as well as the allocation to various departments, and you have to again allocate that or evaluate that basis. Here they're just giving you examples based on square footage of how much of your department utilizes a very common methodology. Again, they're just showing you sales department and how you're going to allocate those. Again, there's a variety of methodologies, and you have to evaluate it. Is that methodology appropriate for the business and so forth? Again, they're just giving you more examples of this. And then you have an income statement, and yes, are these fairly allocated? Because you can set, if you're getting paid on profits, this net income, and you get 10%, yeah, you want to start evaluating this. And so having an understanding of how these numbers are created and managed can affect your bottom line on a personal level. It surely did for me. Department contribution to overhead. Department revenue minus direct, your direct expenses, and then equals your department contribution. It's used to evaluate department performance and so forth. So again, get comfortable with these terminology. They're just going to give you some examples here. Investment center return. Here is a term you're going to see often is ROI, return on investment. So get used to this term. It's a very common term used in the financial industry. And they're just taking, your net income divided by your average assets, and getting that return on investment. And it is used on a comparative basis and so forth. So, compensations will be tied to this very heavily. Again, they're going to give you some examples of this. I want to get to an important area of this chapter that I think the book does a horrible job of presenting. So let me first finish up on this one. So balance scorecard. It's also very much sometimes known as the term dashboard. And this is like they'll have a variety of metrics that the executive staff and the CEOs will look at to evaluate how well that organization is doing. Comparable to like your dashboard in your car. You have a variety of gauges that's telling you different things of what's going on. And those things are not always accounting based or financially based. It could be like number of customer complaints, a variety of some different forms of measurement. How many times our business is getting in the news, for example, and that so forth. But they'll have a variety of gauges, and that is known as a scorecard. I know it more commonly as a dashboard. I'm not going to get into the global view, cycle time. I'm not going to talk about this. Again, it talks about efficiency here and different ways to get more financially efficient, more operationally efficient, shorting your manufacturing time, as an example, shorting maybe your delivery times. I mean, I know Amazon works very hard at reducing the amount of time it takes to get the customers their product, and so forth. Okay, I want to talk about this one area called transfer pricing. It's in the appendix. the book does, in my opinion, a horrible job of completely omitting the importance of this area. Because when you first read it, you got to think, is there anything more boring? Just the opposite. So let's first talk about what transfer pricing is. Transfer price is the amount charged when one division sells goods or service to another division. Boring, right? Very boring. Hold on. Fasten your seatbelt. For instance, you have, at the production department, maybe shipping it off to the phone division and so forth. And at what price do you transfer this to? And often management will assign that price and so forth. What the book forgets to mention is that this is the strategy used most often for companies as well as individuals for tax avoidance around the world and even domestically in the United States. It is the biggest methodology. And so it's a huge issue. Let me give you an example here. How does Apple avoid taxes? This is an article from Forbes magazine. I will post a link so you can actually read this article. But for instance, Apple has shifted off about $200 billion $200 billion off of the United States, which has a high tax rate, and then moved it over to Ireland, which has a very low tax rate. And now Apple's sitting on about $200 billion of offshore funds that they haven't really paid much taxes on. And the United States is trying to get to that. Again, it's a common tactic, and how they do this is through transfer pricing. Again, I will post this article so you can read it. Don't think that this is done just by large companies. Let me just take you a very, very common technique. I was in investment banking, and I would advise and help companies do this, as a matter of fact. So you have a small business owner, and he lives in California. That's where I was operating out of. California has a tax rate of 14%. Wyoming, Nevada, Texas, as an example, has zero state tax. So you'd want to transfer a lot of the company's profits to those low taxing regions. And so what we would sometimes advise is that the CEO or the president of the company set up a consulting firm, and then he provides consulting services for that company and strips out a lot of profits and sets up that consulting firm in Nevada, as an example. This is a very, very common technique, and it's all through transfer pricing. So I'd at least review this chapter, these articles, so you don't get blindsided as you go into business or into intermediate accounting. Hope this helps. Again, they're just going to show you some examples here, but it is a huge method for tax allocation or avoidance or minimization techniques. I'm going to stop there. This is the end of chapter 24. We have one more chapter and one short appendix that we're going to cover also, and that'll be it for this semester.